In this video, you're going to learn how much cash flow should you expect on a property, or really how much should you be looking for? This is a question we get asked all the time. And so I want to tell you, it really depends. And we're going to look at that. We're going to look at how you should be analyzing this. And then I'm going to just kind of give you a warning and maybe a little caveat to consider when you're doing this, because it's not just really straightforward. It would be one thing if I said, here's the number, but it's not as simple as that. But we're going to try to make it as simple as possible. Here we go. We're going to talk about cash flow, of course, which is really money left after the expenses are paid. It's just what you get to put in your pocket. And then we're going to also talk about cash on cash returns, which is more about how your money is going to work for you, the money that you put into the deal. So let's get started right now. Okay, so cash flow. When we think of cash flow for a property, I always tend to think about a door. So a door can be a single family, or you can move from single family to multifamily. And multifamily is typically, when I'm thinking of this, still in the single family mindset. I'm thinking duplex, triplex, quad. And so what we like to say is aim for around $100 to $200 per door, and 100 being the minimum, and then anything 200 and above is probably going to be a good deal. Again, when you're buying rental property, this is not a get fast method of investing in real estate. You're not going to retire from your job or quit your job after buying one rental property, but it's the overall. You can really look at the overall appreciation, mortgage pay down, tax benefits, cash flow. All of these things are what make real estate great. But then over time, these rentals can provide you with an incredible income that can either supplement what you're making right now or replace what you're making. So if you're looking at a single family house, $100 to $200, duplex, 2 to 4, tri or quad, you want to talk about 100 a door. That would be 400 minimum if you're looking at those. And so just think in those terms. Minimum 100, 200 above is great. All right, now we're going to talk about cash on cash return. What is cash on cash return? It really is the money you put into that property. What is it producing from a cash flow standpoint? So I'll show you how to do this, but you're really looking to do is measure the annual return on your money, and we'll just look at the down payment. So a good deal on cash returns typically around 10 to 12%, and there's a caveat. You could go a little bit lower, and I'll tell you why. But also the thing you need to think about is cash flow and cash on cash return can increase if you have a property that is increasing in its rent income every single year. Now, that doesn't mean you want to raise rental prices every year on your resident, but in over a period of time, if your rent is starting to increase, then your cash on cash return and your cash flow also increases, right? So those are the things you want to be thinking about. But let me give you just a easy math example here. Let's say you bought a $200,000 property. You put $24,000 down of your own cash into the deal, and you were getting $200 a month cash flow. So that would come out to $2,400 a year cash flow to you after all expenses are paid, repairs, all of this stuff is done with. You ended up with the end of the year $2,400. What you want to do is you want to take that $2,400, the annual cash flow, you want to divide it by how much money you put into the deal, and that's going to give you your rate of return. So here, $2,400 divided by $24,000 of what I put into the deal gives me a 10% return. Very simple math, not hard to determine. Maybe a little bit more difficult to get exactly right every time, but this is how you calculate cash on cash return. Now, what would be a caveat to this? We mentioned it here, right here, that you may, what if you did buy this $200,000 property and then over time it started appreciating? You bought it in a hot market. Well, let's look at that, because here's a picture of Franklin, Tennessee. If you don't know where Franklin is, it's a suburb of Nashville, south of the city. Over the past 25 years has just blown up. And we had a client, and she came into some money and bought some rental properties down in Franklin back 25 years ago. And you can imagine she was probably paying around $200,000 for these properties. Now those properties are more than likely going to be worth, closer to $1 million. But the rental income that she was getting back 25 years ago has increased by a tremendous amount, not normal averages, but a tremendous amount. And so if she was looking at that deal back 25 years ago, and she was like, it's right at $100 cash flow or $95 cash flow, I don't think I should buy it. And she didn't have the foresight to think, well, this part of Nashville is going to continue to grow and do well because everything's moving south of the city. Then she would have missed out on an incredible opportunity. So lower returns, if your cash on cash return is below 10%, it might be okay if you're buying in an incredible market. Now, when she was buying this was probably Class B neighborhood, which A is going to be your nicest neighborhoods in any area or city. Class B neighborhoods are going to be your next nicest, and then you go down to C and D. Probably class B when she bought it, and then moved up Class B plus or maybe even Class A. But I think Franklin's a great example. You can find examples all over the U.S. You can find them in Denver. You can find them in Dallas. You can find them in there's all Chattanooga. It doesn't really matter. You can find these types of places. You just need to know where you're investing. That's the key. So one of the dangers, one of the things that we see people doing that gets them in trouble with figuring out cash flow and cash on cash return is they don't really consider all the expenses. Now, these expenses are going to be things like vacancy. They're going to be things like your CapEx expenditures, which is what we're talking about right here. So think about your HVAC system. What about your roof? How about a hot water heater? Big ticket items. These things happen, like problems happen in these houses. So when you're estimating your cash on cash return and your cash flow, you need to be thinking about when is the roof going to need to be replaced? When is the HVAC going to need to be replaced? Because you're also going to want to save some money for those types of big ticket items. And so again, you just want to set aside reserves for major repairs, even smaller repairs. Some of the mistakes I see people doing is they just have a little bit set aside for repairs and maintenance for properties. That may be okay if it's a brand new house, or it may be okay if it just got completely gutted and rehabbed. But if you're buying an older home, even if it's been rehabbed, just understand when people start living there, things are going to happen. You're going to get the calls. So don't torture the spreadsheet just because you want to make the deal work. All right, so here's the cash flow overview. Again, we're looking at $100 to $200 a door is what you're thinking, 10 to 12% cash on cash return. This can increase as rent increases. Know that less than 10% is probably okay in some really great areas. So know where you're investing. And then also, what are your CapEx expenditures? What is the roof, the HVAC, the bigger ticket items? What do they look like on that property? Because you need to start saving for those. If we can ever help you determine cash flow, cash on cash returns with some of your investments, because we have insights into 30 plus markets nationwide, we'd love to help you. Go ahead. There's links below. You can download a bunch of free resources, our cash flow calculator. Any of those things are yours. But if you want to speak with somebody, go to our website, fill out the form. We'll be in touch. And if you like this video, we'd love for you to hit that like button, subscribe to the channel, and we'll be back with more investor related content just like this.